Okay, guys, good morning and welcome to today's class. So today we're going to cover financial instruments. What we will be doing is I'm gonna go very briefly over the overview on financial instruments. The reason being is I have another video that is we've been quite detailed on the important aspects of financial instruments. So I'm not going to go into too much detail, and then we're going to go quickly into working through a past question paper. What you must know, though, that financial instruments have many standards, similar to group accounting. With group accounting, there's many standards that impacts group accounting. Similarly, with financial instruments, there are many standards that impact financial instruments. So there's three standards that impacts financial instruments. So you have IAS 32, you have IFRS 9, and then you have IFRS 7. We mainly focus on IFRS 9 because IFRS 9 deals with the classification, the recognition, the measurement, derecognition, and all subsequent measurement related items relating to financial instruments. So the typical accounting treatment we'll find in IFRS 9. So initial recognition, initial measurement, subsequent measurement, impairment, derecognition, all of those type of stuff you find in IFRS 9, and that is a standard we mainly use. Then you have IAS 32. IAS 32 is a standard specifically got to do with the definitions of financial instruments, but it's not like it is not how can I say, like a typical definition section. It is a detailed standard on explaining what is a financial asset, what is a financial instrument, what is a financial liability, what is equity, what is a hybrid instrument, and all of those type of stuff. Um, how to split a hybrid instrument. Between a hybrid instrument is an instrument where it is a instrument that have debt and equity. So it shows you or explains how do you split it, how to calculate the split, and all of those type of stuff. So IAS 32 is very important as well, but we hardly focus too much on that because IFRS 9 is the big standard. Then you have IFRS 7. IFRS 7 deals with all the disclosures relating to IFRS, relating to financial instruments. If you just think about other standards typically go in this order: objective, scope, initial recognition, initial measurement, subsequent measurement, derecognition, presentation, and disclosure. IFRS 9 do not have a disclosure section because the disclosure is found, a separate standard on its own is found in IFRS 7. Now, for our purposes, we're not so big on it. In the real world, that is extremely big. So a lot of companies have a financial instrument somehow or the other. So all financial service companies have financial instruments. So the level of disclosure that they go through is extensive. So IFRS 7 gets used extensively in in a financial services company. Um, so as a financial accountant, when you go to a financial services, you really need to know IFRS 7 really well, because you need to be able to do all the necessary and appropriate disclosures. And then many other companies also use, but maybe not as extensive. So for example, Woolworths, Truworths, Foschini, them, they all use the IFRS 7 extensively because they have debtors on their books. So IFRS 7 is really important, maybe not as important for us academically. We do need to know about it, but the real works of IFRS 7 is done in the real world. So those are the three standards. So our main focus is going to be on financial, on IFRS 9 financial instruments. Just take note, IAS 32 deals with classification as well as IFRS 9. So what's the difference between the two? The classifications in IAS 32 is going to do with whether something is an asset, debt, or equity. the classification dealt with in IFRS 9 is that you know you have a financial asset. You just need to know how are you classifying that financial asset. Are you classifying it as amortized cost? Are you classifying it as fair value through OCI? Are you classifying it as fair value through profit or loss? So IFRS 9 deals with that level of classification. IAS 32 deals with the classification on a higher level, which is whether it's asset, debt, or equity, and whether you have a compound instrument, whether and how to split a compound instrument, and all of those type of stuff. Okay, so that's just a brief overview on the various standards. So our focus is going to be IFRS 9, and I'm just going to spend about 10 more minutes on the key issues of IFRS 9, and then we're going to go into a question. I will share the financial instruments masterclass that I held, I think last year sometime, where we went quite in detail with IFRS 9, how to classify and all of those type of things. So what you must know when you have a financial instrument, so a financial instrument, loosely, like broadly speaking, is you have a financial instrument when on both sides of the transaction, you either have a financial asset on the one side and a financial liability or an equity instrument on the other side. So the one party must have a financial asset and the other party either has a financial liability or an equity instrument. If that is the case, then that transaction would then that items will be fall within in the standard of financial instruments. So as you can understand, the definition tells you what is a financial instrument, that the one side have a financial asset, the other side have a financial liability or equity instrument. So that means we need to know what is a financial asset and what is a financial liability or equity instrument. Okay, so just take note of that. So think about it like this. Let's say you shop at Woolworths and you use the store card of Woolworths. So when you buy on the store card, so you owe Woolworths money, right? From Woolworths' perspective, they have someone owes them money. So they recognize, say, debit debtors, credit revenue. Okay, now how do we classify debtors? What is debtors? So remember, if you look at all the asset standards, there's no standard called debtors. So we need to know which standard does debtors fall into. So the way you think about it, you just ask yourself, what are all the standards relating to assets? So the standards that relates to assets, or at least the ones that we cover, would be IAS 16 PPE. It would be IAS 38 intangible assets. It would be IAS 40 investment property. It would be IFRS 16 leased assets, what we call it, leased assets, right of use asset. It would be IAS 2 inventories. Okay, then it will be IFRS 9 financial assets. So those are the six asset standards that we deal with. There may be more, right? But those are the six that we deal with. So whenever you come across something and you want to know how to classify that particular asset in terms of which standard, just tell yourself, these are the six standards that we cover. So which definition does it meet? So if you go through that process, what you would know is that a debtors, can it be IAS 16? Can it be PPE? You need to see if it meets the definition. Can it be investment property? You need to see if it meets the definition, and you just go through all of those stuff. So what you would find that debtors meets the standard of IFRS 9. Well, firstly, if you read IFRS 9, there's a section for debtors, so you would know that debtors is one of it. But also, how does it meet the definition of a financial asset? How does it meet the definition of a financial asset? So how does it meet the definition of a financial asset? So remember, in order to have a financial asset, you must have a right to receive cash, or you must have a right to receive another financial asset. And there's a long other definitions as well. So Woolworths have a right to receive cash because we need to pay Woolworths cash. So that is why, from Woolworths' perspective, they have a financial asset. From our perspective, we have a financial liability because we have an obligation to pay cash, or we would have an obligation to give up a financial asset. So so in our case, we have an obligation to pay Woolworths cash. Woolworths have a right to receive cash. So Woolworths have a financial asset. We have a financial liability. And as a result, the whole transaction is a financial instrument. Okay, so that is how you see it. So like just to explain the classification of an asset, like I remember one of our lecturers, when I was a student, the third year lecturer asked the question, how would we classify prepaid expense? There's no standard called prepaid expenses. Yet on the balance sheet or the statement of financial position, we have a line item called prepaid expenses. How would we classify prepaid expenses? So it all well, obviously comes down to what is the prepaid expense relating to. But let's say you have insurance, right? So you pay insurance 1 year in advance. So we need to be able to pick up how to classify prepaid expense in terms of an accounting standard. So we know it's an asset, but which standard applies to prepaid expenses? And the answer actually is an intangible asset, because what is the benefit of a prepaid expense? So, so, so because we have a right to receive the benefit of whatever the prepaid expense relate to. So it does depend on the type of prepaid expense, but typically a prepaid expense is simply the right to receive the service. So a right is something intangible. As a result, it will be classified most likely as an intangible asset. But in most cases, prepaid expense on financial assets is captured with trade and other receivables. So there's different ways of classifying a prepaid expense, but the question what I wanted to get to is to start to think. We just see line items on the balance sheet. You must be able to look at the balance sheet and see the different line items and be able to ask yourself, which accounting standard applies to that particular line item. So in some of it is very easy. Inventory, we see inventory, we know it's IS2. PPE, we know it's easy, IS 16. But something like debtors, there's no standard called debtors. There's no standard called cash. There's no standard or bank. There's no standard called prepaid expense. So when you see those line items, you must ask yourself, how would we, which accounting standard applies to debtors? Which accounting standard applies to prepaid expenses? Which accounting standard applies to bank? So those are the things you want to think about. Those are generally technical questions that I could ask you. Okay, but that's besides the point. So let's move on. So now we know we have a financial asset or a financial liability. With every asset, with every liability, it goes through 3 stages. Every asset, every liability goes through 3 stages. Initial recognition, that is the first time it comes onto the books. Derecognition, that is the time when it leaves the books. And then everything in between initial recognition and derecognition, that is the lifespan of the asset on your books, and that is known as subsequent measurement. So as you can understand, something coming onto your books, that is like a one-time event. Something leaving your books, that is a one-time event. But everything in between is that is the lifespan of the asset on your books. So that all the meat, a lot of the meat lies over there. So in subsequent measurement, in almost every asset standard, that is where the meat lies. So just take note of that. So when it comes to a financial asset or a financial liability, initial recognition is about, you need to answer 2 questions with initial recognition. When do we recognize? And once we know when we recognize, we then answer the next question, at what amount. So when do we recognize? It is just basically when the parties become when the contract when the parties become when the contract and the parties, they have like with the parties within the contract have a right to receive something and the other person have an obligation to pay something. So whenever that takes place, that is the date when we recognize. So for example, if we use the Woolworths example, the moment you purchase on credit, you walk out with the goods. It's that moment when Woolworths have a right to receive cash. It is that moment when you have an obligation to pay cash. So because the transaction have taken place. So as at that point in time when you have to recognize. So now the question is, at what amount? For Woolworths' perspective is very simple. Whatever that receipt number is, whatever the amount on the till slip is, that is what they're going to recognize that. But from a financial instruments point of view, this is extremely important to take note. The amount at initial recognition is not the cash amount. The amount is not the amount that you pay or the amount that you receive. So very important, at initial recognition, when you recognize, the amount is not the payment or not the amount you pay nor the amount you receive, but the amount at initial recognition is the fair value of that item. So in most cases, the fair value and the cash amount is the same. So it will simply be, if you have a financial asset, it will simply be debit financial asset, credit bank. Okay, so be debit financial asset, fair value, credit bank, the cash amount, but the cash amount and the fair value is the same. Or it will be debit, what did I just say now? Debit financial asset, credit bank. Or it will be debit bank, credit financial liability, and but the debit bank is a cash amount and credit financial liability is the fair value, and the two amounts are the same. But if there is a difference, if let's say the fair value is 100,000 and you paid 90,000. So what we will say, debit financial asset 100,000. The financial asset or the financial liability is always recognized at fair value at the date of recognition. Okay, at initial recognition, the amount is fair value. And then we say credit bank 90,000. So now I have a debit column with 100,000. I have a credit column with 90,000. So the credit column is missing 10,000 because the journal needs to balance. So we know it's going to be credit something 10,000 Rand, because if we have 100,000 in debits and we have a 90 plus 10 in credits, that gives us 100,000. The journal entry balances. So that 10,000 Rand, if it's a credit, it's called a day one gain. If it's a loss, it's called a day one loss, and it goes through profit or loss. So it's a P&L line item. So remember, the financial asset, the financial liability is always recognized at fair value. And then you recognize bank, whatever the bank amount is. If the two amounts are the same, the journal balances. If the two amounts are different, there will be either a day one gain through profit or loss, or a day one loss through profit or loss. Okay, so just take note of that. Now, so those are the two questions that basically every asset you have to answer. But when it comes to financial instruments or financial assets, there's a third question you need to answer. And that third question is, how do we classify a financial asset? So take note, the classification relates to, so when do you classify? You must classify at initial recognition. So you need to classify actually at inception of the contract. So you need to classify at inception of the contract. Inception of the contract is when you agree to the terms. Okay. So inception of a contract is once you agree to the terms of the contract, you're happy. It's at that point in time where you need to classify the financial asset. The classification relates to subsequent measurement, but you don't do the classification when subsequent measurement takes place. You do the classification at inception of the contract. Okay, so therefore, generally inception, the initial recognition will be more or less the same. So at initial, so basically at initial recognition or at inception of the contract, you will classify. You classify either amortized costs or what's the other one, fair value through OCI or fair value through P&L. So what you must understand, the main idea that IFRS 9 is trying to achieve, that most financial assets needs to be classified at fair value through profit or loss. That is like the default rule, that financial assets should be classified as fair value through profit or loss, unless it meets amortized costs, unless it meets fair value through OCI. So amortized costs and fair value through OCI is not the default. The default is fair value through P&L. So that is why, because it's always fair value through P&L, unless amortized costs, unless a fair value through OCI, that is why the way we do the classification, we first test whether it meets amortized costs. If it doesn't, then we move on. Then we test whether it meets OCI. If it doesn't, then that means it is fair value through P&L, because that is what IFRS 9 is trying to achieve, fair value through P&L. Now, the way we do the classification test for amortized costs, then we test for fair value through OCI. If it's none of those, it will be fair value through P&L. So the way we test for amortized costs, the way we classify a financial asset is based on the business model of the instrument. Okay, so it's the business model of the instrument, and they call it like the cash flow test. Okay, so it's the business model of the financial instrument, and they call it basically like the cash flow and characteristics test. Okay, so number one, you must ask yourself, is the asset held in a business model to receive contractual cash flows? Okay, so that the word contractual cash flows. Okay, so when you receive dividends, dividends not a contractual cash flow. It's not regular. Okay, dividends you receive as and when a company decides to declare. Okay, so just take note of that. So where interest is a contractual cash flow, because in the contract there is a stipulated every 12 months, every 6 months, every 3 months, on these particular dates, you will receive interest based on this percentage. So that is a contractual cash flow. Okay, and then also the payment is going to be stipulated when payment must made. So there's a contract stipulating all the cash flows, how it will take place. When you have an equity instrument, there's no contractual cash flow. You sell your share as and when you want. You receive dividends as and when a company declares. Okay, so there's no contractual cash flow with an equity instrument. Okay, so anyways, so how do we have a look? Test number one, is the instrument held in a business model to collect contractual cash flows? So is management intention to collect contractual cash flows? If yes, we move on to the next question. Are these contractual cash flows solely payments of principal and interest? So it must only be principal and interest. The principal amount can include a premium or discount, that's fine. But other than that, it must only be principal and interest. If it meets both, then it will be amortized costs. If it meets none or only one, then it is not amortized costs. Very important. It must meet both for it to be amortized costs. If it meets one or none, it cannot be amortized costs. So if it meets, it's held in a business model to collect contractual cash flows, and it is the contractual cash flows are solely payments of principal and interest. Solely, very important, payments of interest and principal, or principal and interest. You'll see the shorthand code SPPI. Solely payments of principal and interest. S for solely, P payments, P principal, I interest. So SPPI, solely payments of principal and interest. So so if it meets both of those, it will be amortized cost. If it's not, it cannot be amortized cost. So that means we are left with either fair value through OCI or fair value through profit or loss. Now, for fair value through OCI, there are only two possibilities, okay? One is voluntary, one is mandatory, okay? So one is where you can choose. So I'll get the terminology that IFRS 9 uses now on the voluntary one. And then the other one is mandatory. So if you have an instrument that closely resembles amortized costs. What do I mean closely resemble? Sorry, as I'm talking, I'll just sip on my coffee before it gets cold. So for fair value through OCI, there's one of two possibilities, mandatory or voluntary, okay? The mandatory one closely resembles amortized costs. So how does it closely resemble amortized costs? One, it is held in a business model to collect contractual cash flows, okay? But the contractual cash flows is not solely payments of principal and interest. The contractual cash flows is payments of principal, interest, and with the intention to resell. Okay, so when you see something that resembles amortized costs, but it includes the resale of the financial asset, then it cannot be amortized costs. Now, just here's an important thing to take note. It has all got to do with intention. So management can have an intention to collect contractual cash flows, and the contractual cash flows is only payments of principal and interest. So that is the intention. So it will be amortized cost even if they sell it before the time. So even if in future they resell the asset, but that was not the initial intention, then it's still amortized cost. It will only be fair value through profit or through OCI if the business model, the whole intention of the business model is to collect contractual cash flows, and the contractual cash flows is payments of principal, interest, and the reselling. So in that case, when that is the business model, so take note the difference between the business models. Amortized costs is to collect contractual cash flows as well, and in the contractual cash flows is principal and interest only. They may resell it in the future. That's normal business practice. You want the best possibility, but the intention, the business model is not to resell. They may just resell, for example, they ran into a liquidity problem. So the only way they can fund the liquidity is to get rid of the investment. That's totally fine. It does not mean now that because your business model is not to resell and you're in a cash flow difficulty that you can't resell. So that is totally fine. But we're talking about a business model that the whole objective of the business model is to collect contractual cash flows, and the cash flows that they are looking to collect, or the contractual cash flows they are looking to collect, is principal, interest, and reselling. So they're actively looking to resell as and when is the best opportunity. So that would not meet amortized costs, but rather it is mandatorily classified as fair value through OCI. Okay. The second option of fair value through OCI is voluntary. That is, a company may choose to do so. So, but when you choose, you irrevocably choose to do so. The word irrevocably means that you can never ever change your mind afterwards. Once you have chosen it, you can never ever change your mind. Okay, it will always be fair value through OCI. So it will be where you invest in shares, equity instruments. So when you see a company invest in equity instruments, there's only two possibilities of classification: fair value through profit or loss, or fair value through OCI. It is going to be fair value through profit or loss unless the company have irrevocably elected, that's the terminology, irrevocably elected to classify it as as fair value through OCI. The word elected means it's voluntary. You chose to do so. The word irrevocably means that once you have elected, once you have chosen, you can never ever change your mind. The reason for this is if you think about the objective of financial reporting, if you look at the conceptual framework, the objective of financial reporting is to provide users of financial statements with financial information that is useful for decision making. Okay. Now, the way the objective is achieved is through primarily qualitative characteristics and secondary qualitative characteristics. The primary qualitative characteristics must be met always, and that is twofold. One, the financial information must be relevant, and number two, it must be faithfully represented. Okay. So the whole objective of financial reporting is to provide users with financial information that is useful for decision making. What makes it useful? If it meets the primary qualitative characteristics, that is relevance and faithful representation. Now, what if you so the whole thing of once you choose for fair value through OCI for shares, you can never ever change your mind. One of the reasons is that the ISB is trying to avoid companies from manipulating their financial statements. Okay, so what you must know, the income statement has two parts. It has a profit and loss section, and it has an other comprehensive income section, and that makes up total comprehensive income. Most people is interested in profit or loss. They don't care about other comprehensive income. They're mostly interested in profit or loss, because profit or loss is the number that talks about your operational company. Okay, so analysts and everybody else interested in profit or loss. That's the number everybody looks to. I mean, you look at valuations when you do free cash flow, you're interested in operating profit. When you look at PE multiple, you're interested in profit after tax and all of those type of stuff. Okay, so just take note. So the profit and loss number is critical. Now, investment in shares can be like an up and down thing, whatever the market does. So sometimes it can be great, sometimes it cannot be so great. So if fair value through OCI and fair value through P&L, you could have just chosen as you'd like. What companies would have done is as follows. When the shares are doing well, the gains are high. What they would do, they would reclassify their their investment in equity shares as fair value through profit or loss, because in the positive gains will boost profit or loss. And then when shares do bad, what they would do, they will reclassify it as fair value through OCI. So now the losses don't hit profit or loss, it hit other comprehensive income. It still impacts total comprehensive income, but nobody cares so much about total comprehensive income. Everybody's interested in profit or loss. So as a result, when shares do well, they will classify all shares as profit or loss, make the profit number looks good. Then when shares go bad, they will no longer classify it as P&L. They'll no longer classify it as fair value through profit or loss, but rather classified as fair value through OCI. And as a result, P&L will not be negatively impacted. So that is one of the reasons why, if you choose fair value through OCI, you can never ever go back. It has to stay as fair value through OCI. So that means that any upside, any downside will always be in OCI. So that is to limit companies from playing around with accounting treatment. So they want people to classify investment in shares as fair value through profit or loss. So any gains impacts profit or loss, any losses also impacts profit or loss. There are companies that do irrevocably elect. Why? They have invested in shares, but they know that the investment in shares is not a core part of their business. So they don't want those stuff to impact any fluctuations, to impact their profit or loss. So that's why they're happy to keep it as fair value through OCI. So that's what you must know. There are two possibilities for fair value through OCI: mandatory, the ones that closely resemble amortized cost, but it includes the resale. And then the other one is voluntary, where you can irrevocably elect to classify an equity instrument, so an investment in shares, as fair value through OCI. So remember, the irrevocably one, the voluntary one, that is only if you're investing in shares, only applicable to that. If it does not meet amortized cost, if it does not meet the two possibilities of fair value through OCI, it will always be fair value through profit or loss. This classification happens at inception of the contract. Okay. Now we go on to, so we can go on to derecognition. For our purposes, derecognition, if you must read the standard IFRS 9 and look at derecognition, derecognition is extensive. Okay, so we don't actually cover derecognition. The only way our derecognition happens is when we sell the item, okay, or when it is fully amortized or something of that nature. But derecognition in IFRS 9 is extremely extensive. I think it's it's so extensive, it's beyond the scope of SAICA's requirements. Okay, that is specialized that you learn when you want to be a specialist in financial instruments. So I think the most that we cover for derecognition is like when we sell the item, when it's full, or like when it's amortized or something of that nature. Okay, so that is most that we think about derecognition. Now we have subsequent measurement. Okay, so subsequent measurement, it all depends on the classification of the financial asset. If it is fair value through OCI or fair value through profit or loss, subsequent measurement is simply got to do with gains or losses. So if there's a gain, debit asset, credit the gain, and then you must clearly state whether the gain goes through profit or loss or whether the gain goes through OCI. If there's a loss, it is simply if there's a loss, it is simply debit loss, credit financial asset, and and you must clearly state whether the loss goes to P&L or OCI. Then with amortized costs, we deal with amortized costs, and it just basically every single year or every single payment period, we will recognize the interest expense, okay, or the interest income, depending whether it's a financial asset, whether it's a financial liability. The only other thing in subsequent measurement, okay, there's more other stuff in subsequent measurement. There could be modifications, there could be transfers, and then impairment. Okay, so just take note, those are the other three typical items. For financial liability, a financial liability in subsequent measurement is basically similar to amortized costs. They don't call it amortized costs, they call it using the effective interest rate method, which is the same as amortized costs. Okay, so the way you treat amortized costs is the same way you treat the effective interest rate method, and that is the default position, unless the company have chosen to measure financial liabilities subsequently through at fair value through profit or loss. So you can, but there are certain instances where you can. The company must choose to do so. If the company don't choose to do so, then it will be the default method, which is the effective interest rate method, which is basically the same as amortized cost. Okay, so that is just basically a high-level overview. You can look at the detailed example. I'll share, when I share this video, I'll share the financial instruments video as well of when I covered last year sometime. I don't know, some of you maybe watched it already, but I'm just going to share it again in any case. And then you can go see a little bit more detail on financial instruments. So now I'm going to work through a question. I think I just need to check which question I selected now. I think I selected a past paper. I think last year's test one. I just want to check. And so I'm going to switch now over into, I'm just going to go fetch the paper, and then I'm going to switch into Excel. Okay. In the meantime, if you have any questions, you can ask or you can type in the chat. while waiting for thing to open, do you have any questions that you want to ask in the meantime? So Nisiwe, Clarice, Kennedy, Sarika, Hio.
I'd just like to know in the second test, what is the amount of concentration they'll place on the previous work that we've studied with it, and the amount that we are doing now? Is there any chance of the previous test material being asked in this test, or is it just this that we're studying now?
Yeah, so who asked that question? Clarice.
It was me, Clarice, yes.
So what you must know, there's always a possibility, but if you go through, like I've seen probably the last 10 years of papers from UNISA, each test is always just focus on that term's work, but that does not mean that they can't change that. But like I said, I think in the last 10 years I've seen their papers, they just focus on that work, okay, or that test's work. That being said, they have in the past like brought through other information, but it's like minimal. Okay, so for example, if I use test 3, for example, or fact 3, you have PPE, right, and impairment. So within impairment, part of a business, part of a cash generating unit, they would include inventory, and you have covered inventory in test 1. So it's like that, but it's like they're not testing inventory in detail. Just inventories are like a basic line item over there. So that is how they bring it through, and that is what you must expect. So it can be, for example, a very basic deferred tax question. Not that they can ask you to do a deferred tax calculation, but you have a journal entry and they don't say ignore taxation. So that means you must show taxation. It's like that. It's not like you must go restudy everything. You just focus on this term test work, but you must know things of prior, what you call it. I hope that answers. Okay, I think I just opened it
Yes,
now.
that makes sense. Thanks.
But you must know for test 4 is going to be very different, hey? For test 4, it's going to be integrated. So anything can come up.
Now what I would like to know, test 4, is it, I know it's 2 days long and it's 100 marks. Is it like the ITC test where you don't have the different sections each, and how long is the test anyway?
I don't know how long is what you call it, but ITC is over 2 days, 2 papers each, 100 marks.
Yeah.
Each 100 marks is 3 hours. 3 hours. I think 2.5 hours writing, half an hour reading. You don't know what you get tested on, but
okay, so that's what I mean. They're not going to divide it up like we're doing now. No. It's going to be just one paper, and you can expect anything.
Yes. So typically, how ITC works is they'll each paper is two questions, like a big question and a smaller question. So question 1 is like, let's say 80 marks, question 2 20 marks, question 1 60 marks, question 2 40 marks, typically, right? I haven't looked at ITC questions in the last few years, but I have briefed over 1 or 2, and they seem to still have the same way, 2 questions. Sometimes it's 1 question, sometimes it's 3 questions, but generally 2 questions, a 60 and a 40, 80 and a 20. The one question will be accounting, other question will be tax. So they have a weighting ITC where they would say it's 400 marks, 4 papers, 100 marks each, 400 marks. That 400 marks, 40% is accounting. I mean, let's say 30% is accounting, 30% is, I'm just giving it roughly. They have a range like of each subject. But let's just say there's 30% accounting, 30% auditing. That's 60%. Then management accounting, finance and strategy is 20%, and taxation 20%. So they'll just get the marks like that. So 20% of 400 marks, 20% of 100 marks is 20. So 20 times 4. So over the 400 marks, tax will be around 80 marks. So how they'll do it, they'll have one 80-mark tax question, or they would have two 40-mark tax questions, 160, 120 in different papers like that. But they'll generally have two subjects in one paper. The big question will have one subject, and the other smaller question will have another subject. So when they talk about integration, it's not the way you and I think about integration. Integration to them is it's in one paper, but it's clearly separated. It is not like you get the valuation question and they say, yeah, compile the valuation, audit the valuation, and do the accounting treatment for impairment. It's not going to be like that. How they do it is it's one question paper, one business, one question paper. Then one part of the question paper, the business is focusing on an expansion. So now they'll test you on capital budgeting. Other part of the paper, the business is focused on revenue recognition. So then they'll test IFRS 15. So it's clearly separated. It is just that you need to know all your subjects in that one paper. You just don't know which you don't know which one is coming. Where with currently, you're going to go write accounting. You're going to go write tax. So you just have to go with your tax mind or with your accounting mind. The integrated paper is saying you need to come as a qualified CA with all of your knowledge, and based on what they're giving you, draw on that knowledge to answer anything that comes your way. But it's not integrated that with the same section is tested across all four subjects. It is clearly separated. When they ask you do capital budgeting, you will see clearly in the question paper what section of the paper is relating to the capital budgeting part, what section of the paper is relating to the revenue part. So that is not complicated as you think. It is just that you need to know all your work when you go into those exams. That's the only integrated part about the integration. So I hope that clears and doesn't make you feel stressed with this for. It's not going to be that hard. So I'm going to switch over now into this question. Let me just see if I wanted to cover this one. Yeah, okay. So we'll deal with this, that bond at fair value, and we will deal with preference shares. Okay, let me just see this. Yeah.